In this video, pattern trading expert Suri Duddella shows us how to trade the head and shoulder pattern. You'll learn some characteristics of this pattern, look at its reliability, and walk through the trade mechanics using an example. One of the most popular chart patterns in market analysis is the head and shoulders pattern. This pattern is signified by three successive peaks, resembling two shoulders on both sides and a head in the middle. The head is the largest of the three peaks. This pattern forms near a market top. It reverses its prior uptrend and then follows a downtrend from its breakdown. An inverse head and shoulders pattern is simply the same pattern but turned upside down. It follows the same structure as the head and shoulders pattern but in mirror form. This is also a reversal pattern. It forms in established downtrends and then reverses upwards. Suri has done elaborate studies on the success of chart patterns. These studies auto-detect patterns in various instruments and in various time frames. With proper identification, market context, and trade execution, his testing shows a success rate for the head and shoulders pattern of 59%, and for the inverse head and shoulders pattern, a 68% success rate. Remember, past performance is not necessarily indicative of future performance. Let's look at the cattle futures contract for an example of an inverse head and shoulders pattern. This activity occurred in late 2016. We start by identifying key swing highs and lows. These can be located from visual examination or can be programmatically computed. We'll clear away the price candles for a moment to get an uncluttered view of the pivot points. We'll bring these candles back later. It's easy to spot the head, the left shoulder, and the right shoulder. The next step is to identify the neckline and the length of the head. In an inverse head and shoulders pattern, the neckline is formed at the peak of the lowest shoulder. One of the strengths of pattern trading is that it is objective. It provides clear and exacting entries, stops, and profit targets. The rules for head and shoulder trading rely on the height of the head. For an inverse pattern, this is the vertical distance from the neckline to the bottom of the head. In this case, it is 11.7 ticks. We'll use this measurement for our calculations. For the pattern to qualify under Suri's definition, the height of the largest shoulder should be less than 78% of the height of the head. The left shoulder is the largest of the two and measures a height of 6.6 ticks. A height of 6.6 ticks is 56% of 11.7 ticks. This is less than the 78% maximum, making this a valid inverted head and shoulder pattern to trade. After right shoulder formation and pattern completion, if price closes above the neckline with increased volume, enter a long trade above the breakout bar's high. Place a stop below the low of the right shoulder. This defines your risk, which is shown in pink. Profit targets are projected from the neckline level based on the height of the head and using Fibonacci ratios. The first target range is 62 to 79% of the height of the head above the neckline. The second target range is 127 to 162% of the height of the head above the neckline. You can review the Fibonacci retracement levels and test the math on your own. Now we'll bring back the price bars and see how this trade developed. In summary, the head and shoulders and inverse head and shoulders patterns have a high level of reliability. Like in any pattern, they must be traded with proper identification, its market context, and increased volume to signal pattern breakout. Strict money management and risk rules should be used for trade execution. To subscribe or watch another trading video, click below.